Now, real quick, I just want to remind everyone of some of our recently posted content on YouTube. Just posted today, a few hours ago. We posted a follow-up to that covered combinations discussion we had on Friday. This time we look at the outcomes and expectations using the Power Options historical tools and the trade simulator tool on radioactive trading to help us. Also today, we posted a discussion for Salvatore on hedging a portfolio against a market downturn using SPX index options, what tools to use on Power Options to identify the best potential put based on your expectations of a decline and how to analyze that. Of course, earlier this week, we posted that introduction to covered combinations. What is it? When to use it? Pros and cons. Backtesting covered calls with different expirations. Rolling a successful bull call debit spread, the effects of rolling each individual leg versus rolling the whole spread. We're just exiting the position. And about a week ago, we discussed the long butterflies, comparing an at-the-money butterfly position versus a bullish or bearish skewed position. You can just go to the YouTube channel for Power Options, search for Power Options, click on the videos link to access all of our recent videos and some of our quality older videos as well. Now, we're going to pause the screen. We're going to navigate over to Power Options. We're going to use Power Options as our guide to, of course, help us answer the questions that come in today. We did not have any questions come in via email for today's presentation. So everything is fair game here and all questions are open. Pierre, good afternoon, Pierre. It's great to see you all here. It's great to see you all here, but it's great to see you here, Pierre, as well. Good to see you back again after a while. Now, we haven't seen the market sentiment tool update yet. I saw some interesting things. We didn't see big changes. We saw some alleviation on the Dow a little bit, and we saw some neutral on SPY, SPX after the market opened up, then digested some of the jobs information, sort of settled into a groove there and pulled back down. But this was from yesterday's close, where we have 3 bearish indicators out of our 13, and 10 are resting in neutral. There are no bullish indicators out of the 13. This will update while we're on the presentation. Oh, maybe it just updated right now, as a matter of fact. It went down to 2 and 11. We have the put-call volume ratio is bearish, and knocking on the door, the SPX gap over the SMA 20. The percentage of stocks over the SMA 20, I believe that was the third one that was bearish before we just clicked over. Stocks hitting a new 52-week higher low. That's right near the bearish range. And the number of days the SPX has been above the SMA 100, that's in the bearish mode. SPX MACD gap is getting close as well. So we'll start to see a sell warning if we get up to maybe, I think, 4 bearish indicators and no bullish, with the remaining 9 or so indicators being neutral, or if we get up to 5, we'll start to see the sell warnings as well. So we haven't quite hit that yet, but I was expecting to see that this today, actually, at the close, looking at some of the numbers, but I guess we gave up one, and we didn't gain on the other 2 yet that are knocking right on the door. So didn't quite go into sell warning mode with the market sentiment tool yet as well. Okay, John asked a question here. He did watch one of those videos that we had posted relating to hedging the market, the one we posted today, excuse me. He watched some of it, hedging against a market downturn. And he said, in the video, I mentioned that to use the insurance tool under the married put tab. If you have stocks reaching up to a new high and you're looking to hedge those, he was asking, should I use the SPX discussion in that video to hedge the portfolio, or should I look to protect the individual stocks? Well, it depends on the portfolio size, John. If you're just trading 15 to 20 stocks right now, maybe you're trading them as a covered call, maybe you're trading them as a covered combination. If you're already trading them as a collar, you might not need to protect those because you have the protection built in already. What I was referencing in the video is that if I just have some shares of stock that are core holding in my account, maybe 3 or 4 stocks, maybe a couple hundred shares, maybe 1,000 shares, maybe 2,000 shares, whatever it is, rather than perhaps protect those by using just a broad-based ETF put option or index put option, I'd rather look to protect those if I feel they've hit a top and I'm worried about a decline coming out. I'd want to protect those stocks individually. And the insurance tool under the married put tab is the tool I was referencing, and we'll put together another presentation next week, one we like to call the hat trick for locking in gains, but we'll give a quick preview right now. One of the positions I'm in is Berry Plastics, BERY. That is a married put position I opened following the rules in the blueprint, been in it for a few months, have rolled the put up using one of the income methods, have done income method number 1, selling a call against it a couple of times. The cost basis initially on the stock was about $60.39, and I bought a 65 put for January expiration. This was a few months ago. The put's now rolled up to the 70 strike put for January, which lowered the initial at risk from where I started to even a lower level. Now, if I am just holding shares of this particular stock, BERY, in my account, and I have a cost basis of $60.39, I feel that the market is hitting up at a top. Let's just take a look at it right now. We're up to $68.39. It did pull back 27 cents today, of course. But let's just take a look at the chart. Okay, and let's go back 6 months, about the length I've been in the position. It's probably closer to 4.5 months. But we've been up to this range before, and then you see the stock pulled down a little bit. I got in right down in here, of course, around this 60.39 level when it started to go back above the 20-day moving average. When the stock went up to 70, we were able to do some adjustments, and then it pulled back down. Able to do some adjustments there. Wavered about here. Decent time to sell income against the married put with a 65 strike call. And then the stock sort of gapped up here. That was earnings, and then it's been going up since. Now we're up here in this range. Now, if I'm worried that the stock's going to peter out, that it might pull back down to the $64 or $63 range, this is where you might consider protecting the position individually rather than just using an SPX put option to help with the gauge. So how would we do that? Once again, we go back to married put, and we're going to go into that insurance tool. And like we showed in that previous webinar, using the long option finder, just putting in a few inputs to see which call or which put would give you the best bang for the buck if your stock did hit your target price on your target date. This tool is simple to use as well. I'm just going to put in my stock symbol. My cost basis, I think, was around $60.39. And for now, I'm going to leave it at all expirations. Let's go ahead and just hit calculate. Now the system gives me a breakdown that the stock's at $68.39. My current profit is 13.2%, unrealized, of course, unless I sell it. But I want to stay in this position. Maybe I'm going to stay in this position past the next earnings date, which might be out to November or late October. Maybe I want to stay in this position. Berry doesn't, but if it paid a dividend and it's a core holding, I want to go through the next 3 or 4 months. So this is showing me the available put options we have for our current position and what our new locked-in profit, guaranteed profit would be if we bought one of these put options against the position. So let's look at the October 72.5 strike. A little bit deeper in the money than I'd like to go. The stock at $68.39. I'd like to stay right at the money if possible. We'll look at a couple of those examples. But 42 days out, the October 72.5 put is trading right now for $4.65. Only has 54 cents of time value. That other $4.10 roughly is the intrinsic value. I'm guaranteed to get that back. Now, I had a cost basis of $60.39. I add the $4.65. My new total cost into the married put position is $65.04. But I'm guaranteed in the worst case scenario to get 72.5 back. So we've got a locked-in profit of $7.46 or 11.5% of the unrealized 13.2% that's still there. How does that work? Let's take a look at the profit and loss chart. It's great to see things numerically. I'm going to use that more information button there. We're going to go to the profit and loss chart. Remember, the cost basis is $60.39. The stock's now moved up to $68.39. That's our 13.2% unrealized gain. Buying that in the money put for $4.65 does put me up to $65.04 cost basis. It is going to increase the break even. But technically it isn't, because buying that 72.5 put means in the absolute worst case scenario on October 15th, the stock's anywhere below 72.50. I'm guaranteed to get 72.50 back. So we're going to take in a profit of $7.46 in the worst case scenario, or 11.5%. If the stock continues to move up as we expect, then we still have right now further upside profit potential if it moves up to 75, 80, or so forth. Well, that's a tough order to expect in the next 42 days to the 15th of October, of course, but that's the structure that we have. I mentioned that it sort of increased the break even. Well, I increased the cost basis into this by adding the put, that's true. But in this scenario, there is no break even. I'm guaranteed a profit no matter what the stock does over the next 45 days. And of course, if I didn't think the stock was going to breach 70, 75, and I wanted a little bit extra premium, we could enhance that by just adding a call to create a collar. So the 72.5 put, I don't want to sell a call below this. That would create a bear call credit spread lookalike collar. I don't want a bearish collar. I'm still sort of bullish. I want to leave some upside. So it's not a lot of premium. We're just going to get about 52, 55 cents for it. Let's just put in 50 cents on the bid price. Now I've got a good sort of no risk, what's called a conversion, a straight line profit and loss chart where we're guaranteed to get 72.5 back or 12.3%. This probably wouldn't solve your needs. I'd look to go to the 75 call, but because of the volatility of Barry and because of the strikes available, it's not giving me a lot of premium. I think it was 10 or 15 cents. So at that point, it's not worth it. I could wait till later if Barry continues up to 71 or 72, then sell the 75 call, maybe get 40 or 50 cents. But let's go back to the insurance tool very quickly. And the reason I want to go back here is, as a general rule, what we look for is if we want to continue a position, if we're opening a new married put following the rules in the blueprint on the stock that we like, that we're bullish on, but we want to control risk to single digits as a new position, but we don't want the time decay to affect us, we're always looking at least 140 or 150 days out in time. I want to continue the trade further. This is why I left it at all expirations, so I can quickly see, here's my October's, December's 105 day out, January's close at 140, that's the put I'm holding, not the 80 put, I'm holding the 70 put right now. And going to the 150-day minimum, I'd be going out to March. So let's take a look. Let's just go to March. I'm not going to have as much locked-in profit, of course, but we still have close to double digits. We could buy the 70 put right now, only a 5.2% gain, or buying the March 72.5 put now for 740 with our cost basis of 60.39. And that would still give us a locked-in profit of 7% with 196 days to go to continue to generate income with it using other income methods in the blueprint, potentially still adjusting that put option to increase the locked-in profit status if Barry continues to move up as we expect. This is how I'd use the insurance tool, and this is why I would use the insurance tool, John, on stocks that have moved up in my portfolio, where we're hitting new highs, but I'm concerned about a market correction. I may look to lock in that unrealized profit, especially with earnings coming up in October and November, to go through the earnings date with a guaranteed profit with the proper put in place. And for this, I'm using that insurance tool under the Married Put tab, rather than what we saw in that video just released today about hedging the portfolio with SPX options. Now, if you have 40 stocks that you're not trading as covered calls, 30 stocks, a large number, it can be expensive to cover each one individually using a put option against that security. I understand that. That might be the case where you look to do the same thing that we talked about for Salvatore, using the long option finder to evaluate which SPX or SPY puts would help hedge your portfolio in the case of a 10% loss or 7% loss on SPX over the next 30 days, as was illustrated in that video released today. But if you've just got a few holdings that are core holdings on your account, you're planning on holding them for longer term, whether they're dividend paying stocks or you don't want the cash implications of selling to close and taking the profit, use the insurance tool. See what locked-in profit you can get for the different expirations. And if you're planning on holding it longer term, start with all expirations, see which ones are there, and then look for the first series that's at least 150 days out in time. Get your locked-in profit knowing that you still have several months to continue to leave the upside open, generate income by selling premium against it, or other income methods that are discussed in the blueprint. There's 12 different income methods we use against that married put structure to continue to lower risk, potentially bulletproof the position where we have no risk, as you just saw, and of course still generate income to lower the break even.